Welcome to the market outlook for the week starting August 5th. Last week was one of the most insane weeks that I've seen in a long time. And if you remember, I had mentioned that you can pretty much throw technical analysis out of the window because the week was riddled by market moving events. Like there were all these mega cap earnings, there was FOMC, there was all this jobs data that came out, and the plan that I had laid out for you was that if you either you can skip trading or you can divide your allocation in two, take a couple of trades on Monday or Tuesday, and then save everything for Friday. And I followed that plan myself, and because of that, I was able to take a ton of trades on Friday. All of them were bearish trades after we saw a collapse in the markets. So let's start with the chart of QQQ. And the reason I'm showing QQQ and not SPY is, as you know, that SPY or S&P 500 is the well-behaved cousin of NASDAQ. So S&P 500 has a lot of tech stocks. That means any movement that you see in the triple Qs, you will see a similar pattern show up in SPY, but a less pronounced version. So QQQ usually, the more volatile growth stocks are in NASDAQ. And I mean, it's crazy that, S&P 500, which is like a broader representation of the entire economy, is also very heavily concentrated by tech stocks. So whatever you see in QQQ, SPY will eventually show that. So I like to use QQQ as a leading indicator, and that's why I'm showing you a chart of the Qs here. So if you just use my regular mean reversion indicators on the Qs, there are some interesting things that you will see here. One is, of course, we are dropping rapidly and we are approaching oversold region, but we are not there yet. That means there is more room to fall. The second interesting thing is, if you remember, I point out sometimes when DMI crossovers happen. So July 17th was the time when the tone was set for a market reversal. Of course, you can't take one indicator and base your analysis on that. You have to take multiple things into picture, and especially when earning season is in play, anything can change. So because a DMI crossover was showing up, and as you know, DMI crossovers are considered very important for longer term trend changes. So DMI crossover happened on July 17th. It was too early to make a call at that time. If you see this indicator, the white indicator that I'm showing you, the arrow, as you know, I'm also developing my own market reversal indicator for months now. Now, yes, it does generate some false positives, so that's why I haven't revealed that indicator to anybody. But every now and then I'll show you when my indicator does give me reliable signals. So you can see that on 717 there's a white arrow indicating that the market's QQQ is about to reverse. The trend is about to change. In this case, it did give me a good signal, but again, due to the false positives I'm getting from this, it's not ready for prime time. So that's a high level picture. Now let me remove some noise from this chart. Let me use 10, 21, 34 moving averages. These are EMAs. And this presents a very clear chart for you and makes it easier for you to see. If you have been following me for any amount of time, I will bring up these EMA charts when I see a significant change in trend about to happen. And to spot those moments in time, I use these EMA crossovers. So, for example, back in November 2023, the beginning of this bull market. So we had an EMA crossover where the blue line is crossing over the yellow and pink lines, and that changed. That was the beginning of this bull market. And then as long as the blue line stays above these two lines doesn't cross over, you can primarily take bullish trades while using bearish setups as hedges. So that's what we saw until April. That's when we got a EMA crossover, and I think that was like a 5% pullback in Nasdaq. I was at that point I was hoping that I will get a proper correction, but it didn't happen. So we got a 5% pullback, which was decent, but not exactly a correction. And then we got reversal again in a month, and market just went up after that. Now we are again at a point where the EMA crossover has happened on 24th of July. So for anybody looking for early entries, you could use something like this, EMA crossovers. Now the problem is I could have taken a lot of bearish trades when this happened, and I've been pointing out on our Discord server that this is happening. But because of Apple earnings, because of Amazon earnings, Microsoft, Meta, I was holding back. So I didn't want to go all in because, as these are trillion-dollar companies, mega cap companies, which can reverse market direction in a matter of a day. This crossover has already happened on July 24th. So once the crossover happens, as a technical analyst, what you can do is you start taking trades in that direction. In this case, the direction is to the downside until the EMAs start changing direction again. Now I'll give you an example. If you go back to the 5% pullback in April, so EMA crossover happened here 15th April. You can continue to take bearish trades and keep watching the blue line. When the blue line starts finally crossing over, that's when you switch direction. Now of course, waiting for confirmation means you will always miss out on the bottoms and the top. So in this case you did miss out this move. So let's see what that move is. So this is a 5% move in QQQ. So from the highs, QQQ went down 7.18%. Sorry, I said 5% earlier. This was a 7% correction, pullback. Corrections are 10% or more. 7% pullback, pretty decent size pullback. So if you had waited for this EMA crossover to happen again before you go bullish, you would have missed out that from this point to this point, 4.5% of that move. Now, of course, look at what happened after that. The market shot up once that crossover happened. So you would have plenty of opportunities to go bullish after that crossover has happened. Although you will miss out on the bottom, also be aware that whenever markets switch direction, all the trades you have been taking before that in the previous direction will start going against you. So always be prepared for when market reversals happen for, I would say, 2 to 3 weeks of trades going down the toilet. So that's why it's important that one of the rules I teach you is when you have a losing week, you need to cut down your trading volume in the following week by half and keep cutting it down until you again start seeing more winners than losers. And that's when you can start ramping up your trading volume again. That's what saves you from these big portfolio drop downs. Now, having said that, let's talk about Fibonacci retracements. So I have slapped this Fibonacci retracement on QQQ. I've had this on this chart for a long time. And what I've been pointing out is that 61.8% retracement level is the most likely zone where markets can reverse. That is widely considered an area of support. And then in the previous video, I have also talked about always look for areas of confluence. So not only is it a significant area for reversal in terms of just Fibonacci retracements, it's also an area of support. So I've drawn a support line around 447, and this is also an area of support. So Qs are exactly at that point. They have slightly breached this area, but this is a place where markets could reverse. Now, having said that, let's talk about corrections for a moment. So I'm going to draw this line from July highs, all-time highs of 503, and let's see how much of a correction we have until today. So we have got a 11.6% correction. Although this is a decent sized correction, that doesn't mean that markets will reverse from here. So when markets have gone up this much, corrections like a 22% correction, 24% correction, even up to 30% corrections can happen, and these are pretty normal. So be aware that we could get a reversal from here, but it always turn into a dead cat bounce, and markets could continue sliding from here. So if you look at, so this is, we already had 11.6% correction. If you keep going down, let's see where 20% is. So 100% retracement is 18% correction, which is also pretty normal. And this again happens to be an area of support. So that is one area that Qs could go down. Then the next level is somewhere over here where there is a support area of support. Now that is 27% correction. I think that's a little too much. So my guess would be that we all know that markets need a reset. So either we bounce from here or we continue sliding and go down to 100% retracement, which will give us a nice 18% correction, a nice reset, and will allow us to go bullish. So keep those levels in mind, because the way markets are dropping, this is a very real possibility that we could get down to an 18% correction. A quick look at VIX levels. So I have maintained for almost 2 years that if you just want to use VIX to decide whether to go bullish or bearish, you could use 16 level as that line in the sand. As long as markets stay below 16, you could primarily be trading bullish trades and then use bearish setups as hedges. But once VIX goes past 16, that is correction territory. So either if you were bullish, either you could hit the brakes on your trading, let go of the gas pedal a little bit and maybe start taking some hedges. That's what you could do. Or you could primarily switch to taking bearish trades until the time VIX settles down below 14 level again. A VIX level above 16 usually corresponds to a correction, and that's what we are seeing here. In fact, I mean, look at this spike. I mean, VIX spiked to 29 before settling back down to 23. So as long as VIX stays above 16, you can cross-check this with the EMA crossover that I was showing you earlier. So take a look at VIX, keep an eye on EMA crossover, use both of these to decide when this correction might be over. If you remember, I had stopped covering RRG charts in my last two market outlooks because I was pointing out that RRG charts move slowly and earnings create knee-jerk reactions in the market. So because there were so many mega cap earnings lined up, I was saying that keep watching RRG charts, but don't make your trading decisions based off of that. Having said that, I've been pointing out for the last 2 weeks. Let me switch back to a couple of weeks. So let's start with July 1st. So RRG charts have been showing us a very interesting picture since July 1st. And I've been pointing out that this looks wrong to me. And the reason why I was saying that was markets were ripping. Markets were just going up in July. And RRG charts was showing that except the tech sector, everything is going into the red. And as time moved on, this is July 1st, next week, things are continuing to slide into the red. And what I've been saying is that I've started using RRG charts maybe a year ago. So I'm not an expert on RRG charts, but what I've been saying is RRG charts are showing that everything is going into the red, and that could point to a upcoming correction, a secular correction, because everything was going into the red. And if we do see a correction, then this could be a really valuable tool for you going forward, because it basically pointed out a correction a month before it happened. So again, this is just one incident. I'm not going to place too much weight on that going forward, but I will continue using these charts to try and see if it can give me clues to an upcoming correction in the future. Now, know that in this particular case, that signal came a month ago. So the signal came a month ago, markets kept going up. So if you had taken bearish trades based on the signal that came a month ago, you would have lost out on those trades. So we did get it. We had a delay of a month before the correction showed up. But very interesting stuff. Let's keep an eye on this going forward in the future and see how this can help us improve our trading. Let's talk about some macro stuff. So let's see. Thankfully, we have nothing going on next week. So this is great news, because the only thing that will move the markets next week is the jobless claims on Thursday, which every Thursday comes out anyway. And then PMI data on Monday will have some effect on the markets. Outside of that, I don't see anything special, which is good news. We all need a break from all this data that keeps coming out every week. Earnings. So I'm really relieved that all the mega cap earnings are behind us, but there are some interesting earnings happening next week, which I'll show you. So Berkshire Hathaway on Monday before open. That's one of our watch list stocks. That's not a market mover. That should have some effect on the financials, but that's that. Then SMCI, so all the AI stocks, chip stocks, are taking a beating right now, but we are still in an AI bubble. We will be in an AI bubble until the time when companies who have spent millions and millions of dollars on these $40,000 NVIDIA chips start showing that they are not able to generate revenue from the spend. So until we start seeing those numbers, we are still in an AI bubble. Yes, we may get a pullback and markets will go back up, but the bubble is still there, and any AI stocks, any chip stocks reporting earnings will affect the markets. So in this case, Tuesday, SMCI, Super Microcomputers, is reporting earnings. That should have an effect on the semiconductor space, including all the chip stocks. Airbnb in our watch list, but doesn't move the markets. Shopify, not in our watch list anymore. Disney, not a market mover. LLY, again in our watch list, not a market mover. So basically just a list of humdrum earnings, except SMCI might be an interesting one. Outside of that, a calm week where we don't have to worry about these mega caps coming out with crazy earnings and changing market direction.